When you think about commodities, you might think about the prices of gold and crude oil that you saw in the news last night. But what is the goal of commodities? What is the significance of commodities, particularly the applications to a portfolio of assets? One of the most important applications of commodities is diversification. So the curved line here represents a portfolio of shares, and as we increase in the number of shares in our portfolio, we quickly diversify away from specific risks, shaded near in red. At a sufficiently large N, what we have left is market risk. Now imagine that all the way down here we have a portfolio that mimics the S&P 500. The risk of this portfolio would be the market risk. Here we have the correlations of the Goldman Sachs Commodity Index versus 5 other American asset classes. The MSCI EAFE is an index that tracks the European and Asian Pacific stock markets. You should know what the rest of these are. Over the period of 1970 to 2003, the GSCI had a negative correlation to all 5 of these asset classes. So let's continue this discussion and add our hypothetical portfolio of the S&P 500 with asset X, which has a perfect positive correlation of 1 to the S&P 500, and would have a portfolio opportunity set represented by the black line. Now add the GSCI index instead of asset X, and the investment opportunity set is represented by the red curve. And we can see that with the GSCI we are able to reduce our portfolio risk beyond that of the lowest risky asset in our portfolio. To further illustrate this and show why it's important, let's use our previous assets, and you can see here that with an equally weighted portfolio of the S&P 500 and asset X, the dotted line represents the value of the portfolio. Notice it is quite volatile. Now using the GSCI instead of asset X, we can see the value over time is much more stable, and this could potentially be very desirable to some investors, like those with heart problems. Okay, what else do investors use commodities in their portfolio for? Hedging. Because the historic correlation of commodities and inflation has been positive, investors use commodities to offset the effects of inflation on their portfolios. We can think of this intuitively, as we know that inflation in the developed countries generally occur in economic booms, and it is measured by comparing the price of a basket of goods made up of typical household goods and services. And if the price of the goods are increasing, then it is reasonable to say that the prices of the raw materials used to produce the goods are also increasing. Another application of commodities is speculation. For those who want to actively increase the returns on their portfolio, commodities are great for speculation due to the short-term volatility of the prices. So by now you might be thinking, what factors drive the price movements of commodities? We can explain the short-term volatility with a demand-supply graph. So you can see that as demand increases from D to D1, what we would have is an increase in prices in the short run. But this level of production in the short run is unsustainable. However, in the long run, producers are able to increase production capacity, or maybe there are some new entrants to the market, but the long run supply curve would shift out like so, and it will take the short run supply curve with it. And so we see here that we have more stable prices. Other price determinants are seasonality. The increase of energy to heat homes in the winter increases energy prices. Abundance of fruits when they come into season decreases their prices. Inventory levels, the business cycle. For example, the economic boom in China in the noughties pushed up the prices of the strategic metals used for the mass amounts of construction undertaken over there. Global economic conditions, the most memorable in recent memory being gold, which has dramatically increased in price during this current financial crisis. It's interesting to note there's a lot about gold in the finance literature, and it has been documented that a depreciating USD increases gold prices, as people around the world generally see gold and the USD as being mutually exclusive. So when the greenback depreciates, they hold more gold and less USD. A strong local currency against the USD also increases demand for gold, as gold becomes relatively cheaper to buy, as it's quoted in USD. Increasing oil prices have historically indicated inflation, which causes more people to buy gold. International uncertainty, political instability, war, disaster, these appreciate gold as people seek to store their wealth in gold. Doing what assignment?
Financial economics.
How is it? Is it good?
It's awesome.
Is it hard?
No.
Are you looking forward to portfolio theory and management 3?
No.
Now we know why commodities are significant. We can explore ways in which investors can include commodities into their portfolios. The most direct method of investing in commodities is to hold the physical asset, but this is usually impractical for many reasons. First, there will be storage and logistical cost. Second, they are also illiquid. Another downside is that the investment produces no income, unlike shares and bonds, produce dividends and coupons. This can be significant, depends on the investor's investing horizons. The other benefits of holding physical asset is that it can produce non-pecuniary utility. For example, an art lover invests in painting will derive enjoyment for having the painting to look at. At the other extreme, investors can buy shares in a company that produces the commodity. These provide indirect exposure to the commodity. The downside of this indirect exposure to the commodities, exposure to the company individual business risk. Also, there will be no diversification benefits for a well-diversified share portfolio. The most popular and effective ways of investing in commodities are exchange trade funds or futures. The former are open-ended funds that are traded on exchange just like shares, but with the value being determined by the underlying assets of the fund. Commodity ETFs are best for individual investors looking to add commodities to their portfolio. Commodity futures are also a very effective way to invest in commodities, as they provide direct exposure to the underlying standardized and highly liquid. However, derivatives trading can be very complicated, requiring that investors maintain margin accounts, take offsetting positions, and so future trading is best left to sophisticated or institutional investors.